Good day, and thank you for standing by. Welcome to the fourth quarter and full year 2021 Quanex Building Products Corporation earnings conference call. At this time, all participants are in listen-only mode. After the presentation, there will be a question-and-answer session. To ask a question during the session, you'll need to press star, then one on your telephone. Please be advised today's conference may be recorded. If you require operator assistance during the call, please press star, then zero. I'd now like to hand the conference over to your host today, Scott Zuehlke, SVP, CFO, and Treasurer. Please go ahead.
Thanks for joining the call this morning. On the call with me today is George Wilson, our President and CEO. This conference call will contain forward-looking statements and some discussion of non-GAAP measures. Forward-looking statements and guidance discussed on this call and in our earnings release are based on current expectations. Actual results or events may differ materially from such statements and guidance, and Quanex undertakes no obligation to update or revise any forward-looking statement to reflect new information or events. For a more detailed description of our forward-looking statement disclaimer and a reconciliation of non-GAAP measures to the most directly comparable GAAP measures, please see our earnings release issued yesterday and posted to our website. I'll now discuss the financial results. Net sales increased by 14.2% and 25.9% during the fourth quarter and full year of 2021, respectively. Record growth for both periods. As a reminder, both of our manufacturing facilities in the UK were shut down in late March of 2020 and did not resume operations until mid to late May last year. The increases in revenue were mostly due to improved demand across all product lines and operating segments, combined with higher prices primarily related to the pass-through of raw material cost inflation. More specifically, for the fourth quarter and full year, we posted net sales growth of 10.1% and 19.6% respectively in our North American Fenestration segment, 15.9% and 17.1% respectively in our North American Cabinet Component segment, and 17.6% and 45.6% respectively in our European Fenestration segment, excluding the foreign exchange impact. We reported net income of $20.9 million or 62 cents per diluted share for the 3 months ended October 31st, 2021, compared to net income of $22.2 million or 67 cents per diluted share during the 3 months ended October 31st, 2020. For fiscal 2021, we reported net income of $57 million or $1.70 per diluted share compared to net income of $38.5 million or $1.17 per diluted share for fiscal 2020. On an adjusted basis, net income was $20.8 million or 62 cents per diluted share during the fourth quarter of 2021 compared to $22 million or 67 cents per diluted share during the fourth quarter of 2020. Adjusted net income was $58.6 million or $1.75 per diluted share for fiscal 2021 compared to $40.7 million or $1.24 per diluted share for fiscal 2020. The adjustments being made to EPS are for restructuring charges, certain executive severance charges, foreign currency transaction impacts, and transaction and advisory fees. On an adjusted basis, EBITDA decreased by 5.3% to $37.3 million in the fourth quarter of 2021 compared to $39.4 million in the fourth quarter of last year. For the full year 2021, adjusted EBITDA increased by 21.3% to $126.8 million compared to $104.5 million in 2020. The decrease in earnings for the quarter was mainly due to inflationary pressures and supply chain challenges. The increase in earnings for the 12 months ended October 31st, 2021 was largely due to higher volumes, improved operating leverage, and better pricing. This increase was somewhat offset by higher raw material costs and an increase in selling, general, and administrative expenses. I'll now move on to cash flow in the balance sheet. Cash provided by operating activities was $78.6 million for the 12 months ended October 31st, 2021, compared to $100.8 million for the 12 months ended October 31st, 2020. We generated free cash flow of $54.6 million in 2021 compared to $75.1 million in 2020. The decrease was primarily driven by an increase in working capital, more specifically, the value of our inventory due to inflation. We were able to repurchase $11.2 million in stock, and we repaid $65 million of bank debt during fiscal 2021, $20 million of which was repaid in fourth quarter. Our balance sheet is strong, our liquidity position is solid, and our leverage ratio of net debt to last 12 months adjusted EBITDA improved to 0.1 times as of October 31st, 2021, which is a half turn lower than where we exited fiscal 2020. As for 2022, and as noted in our outlook section in the earnings release, we have chosen not to issue guidance just yet. Demand remains strong, but ongoing supply chain disruptions continue to create uncertainty. With this backdrop, we believe it would be premature to give guidance at this time. We do believe that we should be able to realize margin expansion on a consolidated basis in fiscal 2022, but we also think that margin expansion will be second half loaded. As we sit here today, and to set appropriate expectations for the first quarter of 2022, we currently expect mid-single-digit net sales growth for the first quarter, mostly due to price increases, but margins will be pressured compared to the first quarter of 2021. We hope to provide an update on full-year guidance when we report earnings for the first quarter of 2022. As a reminder, there is a fair amount of seasonality to our business. The first quarter of each year is typically the low water mark, with the second half contributing most of our earnings and free cash flow. I'll now turn the call over to George for his prepared remarks.
Thanks, Scott. We are extremely pleased to announce that 2021 was a record year for Quanex, despite numerous challenges. We reported record revenue and earnings, and return on invested capital continued to improve. In addition, we reported another year with solid free cash flow. In fact, cumulative free cash flow over the past 5 years is approximately $325 million. Also, as Scott mentioned, we were able to pay down $65 million of debt and return $11.2 million to shareholders through share repurchases during the year. While we are very pleased with these results, we're not surprised. In an environment with strong demand, the operational improvements we've made in our manufacturing facilities over the past 4 years, combined with the systemic and permanent changes we've made to our working capital management, continue to yield strong results. I am very proud of the entire Quanex team for the energy, effort, and performance they continue to deliver to our customers, communities, and shareholders. Before providing comments on segment results, I will give some additional color on our view of the events of 2021, the markets we serve, and the macroeconomic environment we currently face. As we entered 2021, there was optimism and hope that the COVID pandemic would soon be under control and that operating environments would return to some level of normalcy. As different variants spread and vaccine uptake proved lower than expected, the optimism was soon replaced by the reality that the battle against COVID is far from over and that measures to contain or minimize the spread of the virus will continue around the world. The year also ushered in a new and in some respects more significant challenge: supply chain stress and disruption. With the infusion of COVID relief payments into our economy, demand for goods in the building products segment increased at record rates. At the same time, the supply chain's ability to ramp up was continually impeded by labor constraints, plant shutdowns or slowdowns, freight issues, and significant weather events. As a result, backlogs for finished goods dramatically increased over the year to record levels, and suppliers have been unable to close the gap. All these factors have worked together to add an unprecedented amount of stress to the entire chain, and as a result, everyone around the world is now seeing high levels of inflation, sporadic deliveries, and unexpected back orders or stockouts with little or no notice. This last piece, limited to no visibility on the delivery of goods, is currently our biggest challenge. All told, the planning and operational environment we see today is significantly more challenging than in 2020, when our primary concern was the labor disruption caused by the pandemic. When looking at the markets we serve, demand continues to be strong across all segments. Low existing housing inventory and low mortgage rates continue to support strong housing demand, and R&R remains healthy due to high levels of back orders and continued strong consumer confidence. Although we continue to watch for a pullback in demand due to inflationary pressures, we are not seeing signs of this at this time. I will now discuss segment results. Our North American Fenestration segment reported revenue of $156.3 million in the fourth quarter, which was 10.1% better than prior year fourth quarter. Solid demand across all product lines, combined with higher index pricing, additional surcharges, and permanent price increases, accounted for this stronger revenue performance. Adjusted EBITDA of $20.2 million in this segment was 15% less than prior year fourth quarter. Volume-related benefits were more than offset by increases in material costs, normalized medical costs, and higher SG&A, driven by incentive compensation. As a reminder, approximately 80% of our North American Fenestration business has contractual raw material pricing index mechanisms. The timing lag of these indices are typically 60 and 90 days, and therefore we are in arrears and chasing price until the rate of inflation flattens or reverses. At such time, we would expect to see a period of margin improvement or catch-up. For the full year, this segment had revenue of $578.3 million and adjusted EBITDA of $75.4 million, which represents a 20 basis point margin decrease from prior year in a very challenging inflationary environment. We generated revenue of $69.7 million in our European Fenestration segment in Q4, which was $12.9 million, or 22.7% higher than prior year, or up 17.6% after excluding the foreign exchange impact. Strong demand in the UK and continental Europe, combined with price increases, resulted in record revenue levels for the segment. Adjusted EBITDA of $12 million in the quarter was 10.1% less than prior year Q4. The drop in margin percentage for the quarter was driven by material inflation, normalization of SG&A expenses, and increases for incentives. On a full-year basis, this segment had revenue of $251.6 million and adjusted EBITDA of $50 million, which equates to margin expansion of 160 basis points versus prior year. Our North American Cabinet Components segment reported net sales of $66.6 million in Q4, which was 15.9% better than prior year. Strong demand, combined with higher index pricing and additional permanent price increases, were the drivers for higher performance. Adjusted EBITDA for the segment was $5.4 million, which represents an increase of 16.3% compared to prior year fourth quarter. Volume benefits, combined with pricing actions, improved wood yields, and normalized expenses, all contributed to the favorable performance by largely neutralizing inflationary pressures during the quarter. For the full year, this segment had revenue of $246.1 million and adjusted EBITDA of $14.2 million, which was an improvement of 17.1% and 22.5% respectively. We were able to realize margin expansion of approximately 30 basis points in this segment, even though we chased price all year. And as a reminder, 100% of our cabinet business has contractual raw material pricing index mechanisms. Finally, unallocated corporate and SG&A costs were $2.1 million lower than prior year fourth quarter. The primary drivers of the lower expenses were true-ups for stock-based compensation expense and lower than planned medical expenses in the quarter. For the full year, unallocated corporate and SG&A costs were $12.8 million, which returned to normalized levels versus 2020, which was a year impacted by COVID. As Scott mentioned in his financial commentary, cash flow generation remains solid despite a significant increase in the value of our inventory due to inflation, and our balance sheet is strong. Our board of directors recently authorized a new $75 million share repurchase program, and we will continue to utilize this authority in the open market and on an opportunistic basis. We have positioned ourselves well and we will continue to evaluate all opportunities to create value for our shareholders. As we look forward into 2022, we remain very optimistic on the demand environment. Our customers are reporting record levels of backlogs, and this, combined with current favorable housing and R&R markets, should translate into continued strong demand. Operationally, we feel we have made progress on our hiring needs by raising starting wages by an average of $1.80 per hour in our manufacturing facilities. Outside of the index pricing and the associated time lags, we have been able to implement surcharges and permanent price increases to help offset inflation. The major challenge we currently face is supply chain and freight uncertainty, and it is for this reason alone that we have decided not to provide specific financial guidance for 2022 at this time. Due to continuing supply chain disruptions, we have very little, if any, visibility into our short-term delivery schedules. In this environment, it is extremely difficult to predict the cadence for shipments over the next few months, or the potential costs associated with sudden changes in schedules. And therefore, we think it is prudent to not provide guidance until such time as we can gain some forward visibility. In summary, we continue to execute on our strategy and are proud to have delivered a record year in a very challenging environment. Demand remains strong, and if the global supply chain stabilizes and our businesses continue their excellent operational performance, then we believe it will translate into revenue and earnings growth in another solid year in 2022. We will continue to stay focused on executing on our strategic plan, and we look forward to reaching a point where we can give more definitive guidance. And with that, operator, we are now ready to take questions.
If you'd like to ask a question at this time, please press the star, then the number 1 key on your touch-tone telephone. To withdraw your question, press the pound key. Our first question comes from Daniel Moore with CJS Securities.
Morning, George. Morning, Scott. Thanks for all the color and taking questions.
Good morning.
I wanted to start with maybe just kind of price versus quantity in Q4. Is it possible to give us a sense of how much of the revenue growth, and in the case of Europe, currency revenue growth, came from price adjustments versus quantity?
I don't have a specific breakdown, but unlike prior quarters, I can say that price/surcharge was really the driver, more so than volume, although volume was up as well.
Across all three, for the most part, at least?
Yes.
That's correct.
That's helpful. And, a very even more difficult question, but if we had to guesstimate kind of true underlying demand for each segment relative to quantity, in other words, how much faster revenue could have grown in the quarter had that not been for supply chain and logistics, any color or sense there, and maybe order of magnitude for, rank order each one where the biggest challenges are, if you will.
Dan, you're right. It is a very difficult question, and for the reason that what we're seeing in our order pattern right now, in our current orders, is demand remains extremely strong across all product lines. But in some areas, we actually have our customers deciding to pull back on their schedules to give their workforce some breaks in as many hours as they're working. So it's really hard to determine how much more volume could have went through the chain because, again, our customer bases are making decisions to pull back. And so I don't want to give you a number of what that would be if everybody was full out. All these things are intertwined, and I think right now you have a combination of uncertain deliveries impacting it, but you also have, our customer base deciding that they have to give their labor force some relief to the amount of time that they're working. So it's really hard to determine and give you an accurate answer.
Understood. Just trying to get a flavor of the relative size of kind of underlying demand, but appreciate that.
What I can tell you, Dan, is in almost every case, our customers are seeing significant growth in their back orders. So, as you go out and look at other companies that report publicly, you'll be able to get a good feel for what they're seeing, and there's still significant pent-up demand.
Yep. No, that's very consistent, certainly. Maybe another one. Based on the prices increases that we've put through in fiscal 21, if we didn't raise prices, again from here, and volumes were flat, what type of revenue growth would that ballpark roughly translate to in fiscal 22?
Yeah, I mean, if you're talking about flat volume, just from a price standpoint, you're probably low single-digit growth.
Got it. Just on what's gone through already, not additional price increases.
Yeah, timing impact of the price increases, because obviously they've been staggered throughout the year.
Exactly. Okay, that's helpful. And then what are your, it's probably part and parcel with the comments you've made, but do you have an outlook for the overall Windows market, either in North America and or Europe, as we think about, fiscal or calendar 22?
Well, that's part of the uncertainty here, but what we have referenced in the past is, for North America anyway, Ducker is a third party we use, and last update they showed for 22 versus 21 on Windows shipments was low single-digit growth at around the 2+% range.
And in Europe, I would say what our customers are predicting, again, with very little and limited visibility, is relatively flat year over year on volume.
Coming from a high base.
Yeah, from an extremely high base.
That's been a heck of a run, no question. Maybe shifting gears, one more, just CapEx expectations for fiscal 22, and then, in terms of buybacks, the prior repurchase authorization executed over 2 to 3 years. Do you anticipate a similar timeline, or maybe being more accelerating that given where we are with the balance sheet? And thanks for all the color.
So on the CapEx front, if you recall, our guidance for 2021 for CapEx was, I think, $30 to $35 million. I think we're comfortable saying around the same amount for 2022 guidance for CapEx. We underspent that budget last year, and it wasn't because we were pulling back on any projects. It's just lead times for equipment are such that everything's moving to the right.
Yep.
On the buyback question, really there's not an answer I can give or clarity there. It's on an opportunistic basis. If we continue to feel that our stock is undervalued versus our peers, which obviously we feel that way today, we could ramp that up over the next several years. I mean, $75 million is actually considerably more in the open market than we had last time, because if you recall, the $60 million, half of that was purchased by one firm. So essentially we sold $30 million in the open market over a 3-year period. So I would think that we could ramp that up.
All right, very good. Thanks for the color again.
Sure.
Our next question comes from Reuben Garner with Benchmark Company.
Thanks. Good morning, everybody.
Good morning, Reuben.
Let's see. So I think Dan asked about the price versus volume in the fourth quarter. Scott, what about the full year in your fiscal 21? Can you give us like a ballpark, how much of the 26% revenue growth was price versus volume?
For the full year, it was more volume than price on a full year basis. Out of that 26% growth, I would say 15-20% is probably volume.
Okay, that's helpful. And let's see. So the supply chain issues you're having, I mean, do you guys, from what you gather from competition, are you guys doing better than your peers in being able to get product out the door? Are you seeing any different behavior from anyone on the pricing front? Does anyone have any advantages or disadvantages relative to you that you're dealing with?
So I'll answer that one, Reuben. In terms of our competition, I think a lot of it is based on your size and scale, and we're unique in the space that we serve, that we're larger. So I think we're doing equal to or better than any of our competitors in acquiring raw materials that we purchase. What we see in the market, there's no one that's getting crazy with price or doing anything that is putting pressure on any sort of volumes. I think everyone right now is facing significant inflationary and supply challenges. And really where we're at in the market today is everyone's kind of protecting their base of customers and doing everything they can to fulfill those needs. So there's not we're not at a point where people are aggressively trying to take shares. We're all trenched in because of the limits in what you can acquire. So it's kind of a trenched warfare right now is really how I would characterize it.
Okay, and then a couple questions on capacity. So two sides of the question here. The first is, do you have any plans for increases in areas where you're either low or looking to expand, like the screens operation or in cabinets? And then on the flip side, any updates on maybe the areas where you are, underutilizing your assets and you guys have been working on trying to offer other products or services? Any progress there that you can talk about?
So on your first question, in terms of capacity expansion, I think we continue to go forward. We talked about adding some mixing and blending capacity in the UK for our vinyl extrusion business. That will continue, and that project's in process. Again, as Scott mentioned, the timing of such is impacted because of just lead times to get equipment. It's extended, but we're looking to add capacity there. We continue to evaluate the screen markets and in areas where we're underserved. We will look to expand our geographical footprint, but that's also going to be predicated on not being able to get enough raw materials to be able to support it. We also have a project in our spacer business in Germany that we're adding additional capacity for our rubber extrusion for those spacers in Germany, and that continues. So in certain pockets, we are going forward and investing and spending in the business. The second piece of your question
on any parts of our business that we have a lot of spare capacity.
The best example of that, and it has been a win, is on our vinyl extrusion business in North America. We talked a lot about focusing on return on net assets, return on invested capital. We continue to expand our capabilities in producing light parts, primarily in fence posts and vinyl fencing components. And I think we've proven that we're a very reliable supplier in supporting that industry, and that continues. It's had a positive impact on our vinyl extrusion business in North America.
Any comments on how big of an industry or opportunity that is for you guys?
We're pretty early into this, Ruben, so, as we continue to develop it, we'll try to give a little more guidance in the future. I don't want to come out and give targets or guidance at this time on the size. We're relatively new into this space.
Yeah, I can add a little bit there. I think the main difference between the fencing sector of the industry versus the window profile sector of the industry for vinyl extrusion is that the fencing sector is bumping up against capacity. So they're looking to add capacity that's where we can come in and help. Whereas on the window side, there's a lot of spare capacity. So it's just about getting our assets up and running. We are an expert at extruding vinyl. It doesn't really matter what the product is.
Great. Thanks, guys. Congrats on the quarter. I know it's a tough time. Happy holidays.
Yeah, thanks.
Thanks, you too.
Our next question comes from Julio Romero with Sidoti & Company.
Hey, good morning. Thanks for taking the questions.
Hey, Julio.
Good morning.
Can you talk about supply chain and freight in Europe and how that differs from your U.S. operations?
Yeah. So in the products that we have in Europe, the supply chain is very similar. although the logistics piece of it is a little more complicated in Europe. So we utilize, for our spacer business in Europe and in North America, the exact same supply base. So they'll face the same challenges as it relates to demand and pricing. We've seen anything that's being shipped internationally is added some additional stress, as you can imagine, with trying to get containers that are shipped or anything that's put on a boat. I'm not going to rehash that story. Everyone's seen it. That's the biggest difference between what we see. Luckily in Europe, our largest silicone supplier is located in continental Europe, so that has added some stability. But very, very similar when we compare the two, Julio.
Okay, so similar challenges, whether you're
yes.
in Europe or the U.S. Okay.
Yes.
And I guess, piggybacking on an earlier question, you talked about your supply chain issues relative to your competition, but how about relative to customers? Just given your business model, your customers are oftentimes your competitor as well. So, are you seeing greater or less supply chain challenges than your customers?
For us, what it's done is, we have such sticky relationships and long relationships with these guys. We've actually kind of partnered up with the majority of them to try to either parlay our buying power together. So it's become more collaborative rather than adversarial, and both trying to find ways to help each other and alleviate the supply chain issues that we have across the board. So I think it's forced us to communicate more clearly. The labor piece of it is still preventing people from insourcing. That environment's still true. So although we're talking about supply chain challenges, in many cases, there's still, although I think we've done a very good job of addressing the labor markets, it's still competitive, which prohibits their ability to insource to the extent where it would be a risk.
Understood. I'll pass it on. Thanks very much.
Thank you.
Our next question comes from Ken Zener with KeyBank.
Good morning, guys.
Hey, Ken.
Good morning, Ken.
So, not your average quarter. The earlier question about fence posts, and like products, wasn't really where I was going to go, but your extrusion plants had real issues in the past. There was capacity. There still is on the the window side. But one of the big things, obviously, in extrusions is just having long cycle runs, right, where you don't have to change out the profiles, et cetera, et cetera. It seems to me, I'm not an expert in this, but fence posts are really just wrapping around. It's just a 4-inch by 4-inch run. So you not only have the growth potential of, your fixed asset, but it seems to me that it's essentially the same run constantly because it's a white, gray, or black fence post where you don't have to change out profiles. Is that correct?
I would say generally you're absolutely right. The window profiles that we do are very complex, and each customer has something different. So the level of complexity on that extrusion is pretty significant. The fence posts, although not identical, are fairly close, and yes, they tend to be much longer runs with recycled material and or more favorable to what you would think on a continuous extrusion process. So, if I were to ask the guys in the plant, they would love loading up on fence posts, yes.
And just a point of clarification, George was referring to our vinyl business here in North America. In the UK, it's completely different. Yep.
Yeah. No, apologies. Can I just go further? What do you find in terms of the distribution channel requirements? I mean, because it's nascent for you, George, so I get it. You don't want to put numbers around it and stuff, but it's clearly something that makes sense from an asset utilization perspective. That's why, right, vinyl siding is so good, right? They just have these long runs. but they have the very tied-up distribution network. Are there unique distribution challenges you face there versus the window manufacturer?
No,
now, I mean, i.e., is there a lot more SG&A? It's very expensive to start building that relationship, even though you get good gross margins? What are some of the dynamics there?
It's very similar for us at this point in time. We are an OE supplier to not only the window manufacturers, but now we're an OE supplier to the fencing. They have a combination of manufacturing and distributing, and we are also selling to guys that just distribute fence posts. So, but at this point in time, we're 100% OE supplier to those guys and have no end distribution to the consumer.
And regional distribution constraints, given that you're running out of Kentucky, is that into Texas and that's kind of the end of your market, or is there something?
No, we're selling to guys all over the country right now. So I would say what we see is that the fencing market tends to be regional with the competitors that we're selling to, but we're selling product that would cover national geographies.
Good. Nice to hear that, guys. All right, now to the more complex part. Appreciate your first quarter guidance, so I think you're clearly helping us there. You did say margins would be up. You're not quantifying that for the full year with a back half lift in margins.
Hold on. Back up.
Go ahead.
On the revenue side, we're saying we should see some revenue growth, mid-single digits, in the first quarter. Margins will be pressured first quarter, not up.
In the first half. Yeah, in the first quarter.
Yeah.
Yeah, no, I got that. Exactly. Sorry if
Okay.
I misspoke. So I do appreciate that near-term guidance, realizing you're holding off on the year. But you did say margins up for the year was your expectations, correct?
Right. For the full year, yes.
Yeah, assuming no disasters in the supply chain, we would expect a solid year.
Understood. Further power. So can we go into this, George? Because you did say it was the transportation issue. So it sounds like you're having there's raw material costs, which are in an index and lagged, but you're seeing actually skyrocketing transportation costs, or is that transportation access in terms of you can't get trucks or your customers can't get trucks? I was a little unclear on that.
I think the answer is yes and yes. I mean, there are times that,
Okay.
inflationary pressures on freight, everyone's seeing it, whether it's through fuel surcharges or just absolute increases in freight prices. That's the reality right now, and probably will be on a go-forward basis. But, and part of the reason why we're not giving specific guidance right now is, we could be at the end of a month or end of a quarter and have, $2 or $3 million worth of shipments that, the trucker doesn't show up that day, and that can be normal. And so it's a little bit of both.
Yeah. Now, as a component supplier, you have to wait for your customer who might or might not, right? Do you think, because your extrusions coming out of Kentucky need to go somewhere, your screens are more or less adjacent to your customers. Is that a fair statement? Obviously, your spacers is out of Ohio.
That is a fair statement. Screens tend to be a very defined shipment, and we usually control our own freight and have a small fleet of our own for screens. That's the least impacted by freight availability.
Right. So this is really about the extrusion part, or is this both the edgers and the extrusion that we're seeing this transportation issue arise?
Primarily, yeah, it's definitely more weighted towards spacers and vinyl extrusions. For the freight challenge.
Well, yeah. So cost neutrality, if you think about, the pricing on the lag, so you get $10 of inflation, you recover $10 of inflation. Is that generally a 6-month lag due to the cost indexes? Is that how it kind of works for you guys? I mean, if there was a number, is it 3 months, 6 months?
It's usually 60 to 90 days are typically the range we see. I don't think we have any indexes that are 6 months in length, but 60 to 90 days is pretty standard.
Longest lag is in the cabinet business.
Yeah.
Okay, and I really appreciate you guys answering these questions. It seems like you guys are running the business well, and I don't want it to be, and improving. So if you have these cost, right, dollar cost recoveries on the indexes you just described, how do you think about that in terms of having margin neutrality, just to catch up for the math, right, of the ratio changing? Is that something you guys have in mind? I mean, I get the cost part, but obviously we look at margins a lot. How should we think about that, perhaps?
I mean, that's a difficult question to ask. I mean, when we look at how the pricing has impacted us, raw material pricing specifically over the last 6 to 9 months, what we've found is that even when we think we're going to catch up with the rate of inflation where it's been heading, there have been times when we didn't catch up enough. So we're at a point in time where we need to try to be more proactive and forward-looking and try to at least become margin neutral.
Right, which your guidance seems to suggest for not guidance. I don't want to put words in your mouth, but your comment that margins will be up suggests that's where your confidence lies for FY22.
Yeah, I mean, I think for margins to be up like we think, we expect at some point, probably more towards the second half of the year, that the inflationary environment will at least somewhat stabilize so we can catch up.
Yeah, the rate of inflation or the slope of the inflation line will flatten or decrease to such a point that we'll be able to catch up on some of the indices.
Thank you very much for your answers, gentlemen.
Sure.
Thanks.
I'm showing no further questions in queue at this time. I'd like to turn the call back to George Wilson for closing remarks.
I'd like to thank everyone for joining today, and we look forward to providing an update on our next earnings call. Have a very safe, happy, and joyous holiday.
This concludes today's conference call. Thank you for participating. You may now disconnect.